taking an unconventional look at stocks, property, bonds, economics, and more. This is the Total Money Management Podcast with Steve Moriarty, Tom Hill, and Jacob Senior.
Hey guys, welcome to Total Money Management. We're back covering the week that was April 8 to 12. And it's fair to say, gents, there's a lot going on. So I'm back with Tom and Steve. How are we doing?
Very well, thank you.
Steve's drinking a coffee.
Yeah.
All right. I'm okay.
Any jets or boats for you this week, Jacob?
Just boats, no jets.
Yeah, foreign cities or anything?
No, I've been Brisbane bound, sadly, this week.
Choppers?
But next week I'm on a chopper to New Zealand.
Are you?
No, I'm not.
God, I was going to say, what a bloody life.
No. It's
Well,
not.
it could be worse. You could be on a plane to the Middle
I
East.
could be in Iran. I could be where
Russia, Ukraine. Who else is fighting? Azerbaijan and Armenia.
Yeah.
Anywhere in the Middle East is just basically the no-go zone.
Yeah.
Well, they
Terrifying.
did that during the week. I think Qantas said they're not flying over. There was some airspace. I think it was Iran or something where they said, we're not flying around that joint.
go.
It's too dangerous.
Well, that's the fair part. I mean, there's a few key points in this week's the week that was. China and US relations are deteriorating. Manufacturing's back. UK market's cheap, and a whole lot of other things we need to talk about. But news has been shrouded at the moment by war and what's to come. So
Yes.
I think it's worth covering that briefly before we get lost in it.
Absolutely.
What's happening?
War and deglobalization, right?
Yeah, which we've been talking about
They go hand in hand
for a long time.
Yeah,
The
well,
Oracle.
remember we said we're going to have an an episode of we told you so.
Yeah. Steve's "We Told You So," and just a list.
Isn't that every episode?
Yeah. It's every day.
Remember
we
I
talk
told you
Steve.
last week it's
Well,
happening again?
But look at the new normal, right? I said 9 or 10 things like monetary policy to fiscal policy, efficiency to redundancy, blah blah blah. And the news is dominating, and it's exactly what I was saying.
And now the Made in Australia campaign.
Made in Australia campaign,
That's the biggest told you so.
right?
Yeah.
There you go.
Are you friends with Albanese?
Oh, I just,
In the back pocket, mate.
mate, I'm Nostradamus.
Send him a pigeon.
I'm old and I've seen a bit. There you go. That's my spiel.
So I
I've
think
been around. Anyway, get on with it.
Last
right.
week we talked about Janet Yellen, and I forgot to ask who the hell Janet Yellen is.
Oh, Jesus, you guys.
And maybe I'm just
Seriously.
Don't you know?
uneducated. Who's Miss Yellen?
She's the
She's
US
the-
Treasury Secretary's.
Can you give
I
me
don't
more
know.
than that?
Former Fed chair. Oh, God, you guys. Oh,
I
my
know.
God.
Well, that's why you're here.
Righto. Next theme will be politics, education, who's who in the bloody global zoo.
Yeah,
you got to learn about these people because they're over there deciding whether you get your weed or your petrol or
Yeah.
because they make serious decisions.
Well, Miss Yellen went to China.
She did.
What's that
And then
mean?
came back.
And then came back.
They
yeah.
let her back.
Well, no, it's funny because when things are going well, you don't need to visit people, right? America's, and China didn't visit each other a lot because, hey, we're happy, you guys are selling us stuff and we're giving you stuff and, it's all good. It's only when things get a bit rocky you go, I better go and see that client, right? You know that yourself in sales, right? They've got a complaint, you think, okay, I'll go to their office and
relationship.
check it out. Yeah. So America and China have got, and this is where it's really important to distinguish between what they say and what they actually do, right? Because what you're seeing is these two sides constantly talking to each other. What you're also watching them do is the stuff that's in the newsletter and in the week that was, which is we're putting tariffs on Chinese steel. Joe Biden this week. Now, mind you, this is April, what are we in? April 20 or something. Joe Biden this week said, I'm going to triple the tariffs on Chinese steel. Well, that doesn't sound like somebody's being friends. The Chinese have said, right, well, we're going to punish Apple and Tesla and, do all these things. Okay, so what you do is you look at the media, which is going, oh, well, that's good. They're communicating dialogue, so that reduces the heat, right, or the chances of a mistake. However, when you look at what they're doing, you're looking at it going, dude, these sides are just going further and further apart, and that's the real point. Most of what you see in politics is about local, right? And we were just talking about it before we came on air about Iran, right? Everyone wants to do something to say to the local people, we won that, that skirmish, right? That's what you want to do because, those local people in a democracy, those people vote for you. Well, you don't want to go and say, oh, look, we did this thing and it was a real cock up. We really lost that battle. People go, well, you're no good. We'll get the other mob in, right? And in the autocracies or the communist stuff like China and Iran and Russia, they also have pressure as well because if you look at those places, they're held in place basically by the violence that, Putin can inflict on local people. Right, or the Ayatollahs in Iran, or who's the other one? The Chinese, right? The Communist Party. If things start to get out of hand amongst particularly young men, they have to do something, right? So the young guys don't vote, but if they all start getting the shits, it's a bit like, okay, hang on, we need to do something here. And so all of that chest beating and war and stuff is all about appealing to the locals that, your government or your leaders are doing the best on your behalf, right? And we're winning.
It reminds me a lot of propaganda, like World War I, World War II propaganda.
Welcome to politics.
So, we might have lost the battle. We might have lost the war, but we've won the battle.
Yeah, we won the battle, but lost the war. Yeah. And that's essentially what it is. It's about, and that's what makes investing in this time a little bit more uncertain because you're trying to figure out what the truth is. Is oil going to 150 or is it going to 50? Right? And as many people that says it's going to 150, there's a heap of people who are saying it's going to 50.
Well, let's talk about oil because usually when war breaks out, energy prices increase. You'd expect oil to increase, but this time slightly different with there being an election in the US. So what we're thinking is Biden's going to release strategic reserves, keep the price of oil stable until he's back in office. I mean, this is
yeah. Well, I think
speculation.
we said that last podcast where vote me until 24 and then go bingo, righto, let it rip to 120 or 130. Yeah. I mean,
it's rare that you go into a war or something, a battle or whatever, and oil and energy prices fall for the long term at least.
Yeah. Oh, yeah. Absolutely. Because if you have a war,
it's somewhat important, right?
Yeah. If you fight a war, well, you've got to have resources. And what's the one resource you need to actually make other resources? Well, you need oil, right? So you've got to. That's why moving back to a war footing, what you've got to have is the first thing you've got to do is secure national resources. This week, Albanese came out with the future manufacturing. Well, that's all about making our own stuff in case things get ugly.
Yeah, we can't rely on everyone else.
The Europeans are now starting up magnesium mining again. Why? Because they realise China's got a lockhold on the critical minerals, right? And that's going to be in a future week that was. But that's why I'm saying you look around as a government and say, okay, what don't we have? Oh, we don't have lithium or, we don't have semiconductors. That's why America said, right, we're going to punish China by not letting them have the latest semiconductors, which are necessary to build the latest bombs, blah, blah, blah.
Yeah. And we've spoken about it before. I'm probably going to mention it in this one as well. US is obviously heavily incentivizing people to go and build semiconductor production facilities.
Yeah, well,
over there. Did they give Samsung and TSMC $20 billion in subsidies?
Yep.
To set up shop there?
Yep.
So that's all continuing, right? We'll probably start to see that stuff happen here too.
Oh, of course. Of course. But that's why I said, Tom, in the new normal, big government is back.
Yeah.
Right? It's not going to be about saying, oh, Tom wants to build a house. Okay, well, let's just let him speculate and here's $1 million. No. It's going to be about we need to channel the money to, Steve's widget factory because he's helping build bombs, right? Build widgets, yeah. Bomb widgets. That's what I mean. It's you're going to get a lot more direction from government. Now, what you're seeing at the moment is a whole raft of, and Albanese came out and said, here's the document, future, made in Australia, right? So what do all the economists do? right? They'll go, oh, this is terrible, it's so inefficient. Well, listen, you dickheads, it's not about efficiency, it's about securing resources. So you guys can take a back seat now because you guys are fine when everybody's playing the game, but they're not playing the game anymore, right? And you know,
Yeah, this isn't purely about profitability now. This is making sure we got the shit we need if we get cut off.
Exactly. Yeah. You see, but economists go, oh, that doesn't make sense. It's like, well, they're not our friends anymore. So, you know, you smart asses come up with a plan. I mean, we're at where we're at because of the economists 40 years ago
Yeah, we've had a good 40
oh, no, we
years.
don't need to build our stuff anymore. We can get it from, you know, our 40-year future enemy.
Yeah.
And that's why I say, you know.
And it'll come around again, right? Another 40 years, it'll be like, oh, we're good now. People forget. We'll start to...
It'll get too expensive. It'll be too inflationary, and there'll be, you know, all the economists of yore will be dead. There'll be a new bunch of economists that go, mate, we should
let
be buying,
them make it.
We should be buying this stuff off Africa, right? Look at them. They got all those young guys over there, and they got factories, and it's cheap, and they got infrastructure. We should buy the stuff off Africa. We shouldn't be building our own, you know, semiconductors, right? And that's why economic history is so important, because you see that it cycles. And that's why I'm trying to say we're just going back to, you know, the old cycle's dead. It'll take 5 years, maybe 10 years, but I'm telling you, it's over, Red Rover. Globalisation is dead in the water, right? And that's why I say the more you look at the articles here, the more you actually look at what they're doing, not what they're saying. They're all doing the platitudes of, oh, yeah, we'd love to do free trade, you know, blah, blah. But now they're all actually saying, yeah, we all know that's bullshit. Righto, we're going to, you know, the Americans are stumping up and saying, we've had enough of this stuff. We're going to build our own semiconductors, right? We can't rely on China anymore because the Communist Party in China are a threat as the Americans see them. So how do we deal with threats? Righto, well, this is what we're going to do. We're going to hobble them by saying, all right, well, you know, we're not going to give you the latest cutting-edge technology.
We'll build our own, and we'll keep it for ourselves.
That's exactly right.
Yeah.
Let's talk about God's country, because there might be a glimmer of hope for the UK right now. It's been cheap for some time. And look, we've been looking at them for a while, and there's never been a great time to kind of go all into the UK. And I don't know if that's the case now, to be honest, but there's a new Labour Party. There might be a bit of optimism and speculation on the new government.
Agreed.
I hope we have a good 20 years or so, because we freaking need it.
You have a look at the FTSE from, go back and look at the FTSE from 2000. It's horrible. It's miserable.
It's shithouse. It's been shithouse for 25 years.
Yeah. Now, again, like you say, Jacob, the Labor Party looks like they're going to sweep into government. That in itself might be a bit of a like, hey.
That might turn things around.
Yeah, things are. Now, do they or don't they? I have no idea. But the point being, at least people will say, we've got change coming. And so, you know, that may be a catalyst. Also, remember, the CAPE in the UK is at about 14.
That's what I was going to ask you.
It's really cheap. You know, it's really cheap. Now, it may stay cheap for another 2 or 3 years, but you can look at some companies there and the dividends are, you know, 6, 7, they're pretty strong. You know,
if you can pick up a 6-7% dividend and a cheap share.
Yeah.
well, look at, you know, not
it's a good deal.
It gets me excited.
It's a hell of a deal.
Well, not investment advice, but you can look at things like British American Tobacco.
I was going to say about the British tobacco.
You love supporting the tobacco companies.
Well, you know, somebody's got to. Jacob's job depends on it.
Oh, that's true. Yeah, that's true.
Notice how all the rich people, all of those industries depend on like bad health, bad food, bad legals, people fighting, right?
So leeches, we're leeches.
Yeah, well, you're not exactly productive, are you? You know.
And all the people that we do help.
Yeah, but anyway,
Come on.
The point being, the UK CAPE ratios came out this week, which is April 20.
Yeah.
But what was it? You look at emerging markets, man, they are really cheap, some of them.
Emerging markets are cheap, yeah.
You know, like well below average. And that's why I reckon they're going to do really well.
But are they, if we're bringing it all back onto...
Well, yeah, but you got to remember, a lot of those companies, a lot of those countries are exporters for a start of commodities, right? So everyone wants commodities. Secondly, some of those emerging markets have got good demographics, right? So you want to go and steal their young people. Thirdly, they're growing themselves internally, right? So, Brazil wants to get richer, Argentina wants to get richer, Poland wants to get richer, right? All that sort of stuff. So generally their prospects for growth are a lot better than a mature country like Australia, where we've got all the infrastructure and stuff, right? You look at Poland and go, man, look at the opportunity here. They need a coffee shop, all that sort of stuff.
Yeah.
Right?
And like we've said a few times, right? Like that whole deglobalization thing, that's going to take ages. So there's plenty of time for these guys to,
to have a good run.
Absolutely.
Capital, mate, one thing I can tell you, if I've learned in life, capital will go wherever the opportunities are. Now, they'll be restricted because you'll either have to be on the Chinese side or the American side. But if you're, like Poland and Europe and Vietnam, if they're all trying to heavily get in with the US, that's where your capital will be sort of allowed to go. See, recently, there's been an influx of Vietnamese money into Australian property markets. And the reason why is because Vietnam is now receiving lots of largesse from America as the place where Apple wants to build its new iPhones, as a surrogate for China, right? Because they want to move out of China. Well, they don't want to, but they're being forced to. So Apple is going, right, we've got to build stuff in India, we'll build stuff in Vietnam. So that's causing investment booms in those countries. Right? Just like when China said, we want to build lots of stuff, and we went, dude, we got lots of iron ore. We had an investment boom, right? We had a commodities boom. And that's what you're going to see. It's going to be driven by the younger emerging markets because that's where the growth opportunities are.
So do you think obviously you have to weigh up your risk when it comes to emerging markets or investing in general, but emerging markets are cheap at the moment. Do you think there'll any potential to go any cheaper?
Oh, Jesus, mate.
I know it's a vague question, but people are going to wonder that.
No, it's a perfectly reasonable question. And here's where it comes down to this. I don't know. Now, here's my other answer. Get your asset allocation right.
Yeah.
Right? All investing is about risk and return. If it's cheap, you probably, not definitely, but you'll probably get a good return. But what if it takes 3 years? Cash, and I think we're going to talk about cash, how to use cash.
Yeah.
But my point being, listen, if I said to you, like we say in Well 2, right, if you've got, theoretically, 90 grand to invest, there's 9 ETFs, right, you put 10 grand in each. But you don't go and say, righto, there's, this emerging markets are Thailand, Poland and China, right? You don't go and go, righto, I'll put 10 grand in every one of them. No. You say, righto, I'm going to put 5 grand in every one of them. Then if Thailand becomes cheaper, no sweat, I'll put in another 1,000 or another 2,000. Right? That's the asset allocation stuff. It's really, really important because it helps you with your question.
But
Steve, what if they get cheaper? No worries, put in more money. You've just dropped your price from $1 to 95 cents or 90 cents.
I think that was the biggest eureka moment for me when I kind of finally understood that first you allocate the capital to the thing you want to buy, but you don't deploy it all in one hit.
Exactly.
All right,
There's a window of opportunity, right? There's a window.
Oh, 100%. If it's cheap and you go, right, I got 10 grand allocated for this, I might start with 5, and then 3 months later, I might buy a little bit more.
Yep.
A little bit more.
Or if it goes up, and this is again the part about asset allocation, is when it goes up, what's the first thing you say? Oh man, I knew I should have had like 7 grand in that, not 5. Well, you can't.
Recency bias. It could have gone the other way.
Exactly right. And then you'll be going, oh, I knew I shouldn't have bought 5 grand. I knew I should have bought 3. So the point being, if you're investing like you guys, you've got 30 to 40 years, right? You guys are young. Well, just because you didn't make an extra $500 on the Chinese ETF way back in 2024 is not going to change the direction of your wealth. What will is constantly winning and not losing money, right? Because if you spend 5 years and you make 100 grand and then the year after that you blow up and lose 70 grand, well, welcome, you just made 30 grand in 6 years, not 130.
Yeah.
That's the point, right? That's the point. Just keep building it up. Right?
Yeah.
And making sure...
And the returns will get bigger anyway if you're not losing money and you're constantly growing. Compounding.
Yeah, on that, we may as well talk about cash while we brought it up. A student Oh, student. God, he'll listen to
Are
this.
you the teacher?
Sorry, Pete.
Hey, Pete, the
I'm
student.
I'm sorry, Pete, the student.
Are you the teacher?
I don't mind, like a client of ours.
Terrifying.
I'm not the teacher. The client of ours, Peter, because his said his name, asked about what do we do? The market's expensive. There's a lot of cash floating around. We're trying to reserve funds as much as possible, or cash equivalents. What's the best way to deploy that?
Yeah, I'm holding more cash than I want to be holding.
Lots
What
of
do I do
cash.
with it?
Yeah.
Well, last night I was watching the footy, but there was an ad that said you could get 5.5%, right, which is on cash. Well, that's a bloody good return for a lot of people. If you have, and this is I think I talked about this previously. If you imagine if you've got $1 million, right? You're 65 or whatever, but you've got $1 million in cash. And you're going, oh man, I need to know something with this cash. Now, if you get 5.5%, right, that's 55,000. Okay, if your lifestyle costs you 60,000, right, because you own your own property and you've got this $1 million in cash, and what you're doing is saying, well, I don't need to do much because I'm earning 55 and my lifestyle's 60, so I'm only paying $5,000 per year extra out of my $1 million. Okay, well, that means I'm going to last, 200 years, right? So the point being that we've had 30 years where cash has been trash because interest rates have been low. And so people have pivoted into stocks or property to try and get a return, right? The old search for yield.
Yeah.
Whereas now what I'm saying is, well, hang on, if you can get 5.5, you really want to convince me that I need to speculate in property or stocks for 6?
Cash is not trash.
6.5?
And it's an unpopular opinion because it's been that opinion for so long.
Yeah.
So now we're going, actually, it's not a bad thing being in cash necessarily.
Absolutely.
And the second thing is something like well one, where you take advantage of the volatility of the market.
Yes.
Which requires a bit more precision.
Yes.
But that's an option too.
Peter, you're doing well one. Stop being greedy. Righto. Okay. But the point is, yes, that it's really funny, because we always think if we've got cash that we should be working it, right? And again, and I just finished writing about this in the Fibs thing, is, the question is not, I've got cash, what do I do? The question is, I've got cash, what rate can I compound it at?
Yeah.
That's the point. Now, at the moment, you can compound it risk-free for 5.5%. Okay? So if you said to me, Steve, I want you to buy this property or buy these stocks, okay, what's the yield? Oh, it's 3%. It's like, mate, I can get 5.5 doing nothing. What happens if the property goes from $1 million to 800? I'm suddenly down $200,000. Or the stock goes from $10 to $8. Well, now I'm losing. Well, so much for the bloody 3% yield when I could have been sitting in the, on the beach getting 5.5 doing nothing. So and again, what you're saying, Jacob, is correct. We've spent the last 30 years going, what do I do with my cash? Where am I going to move it? What do I got to do with it, right? Rather than saying now, what can I do to compound it at a high rate? I'll tell you what you can do. You can wait, right? Or you can wait for a cheap market.
Yeah, wait for a cheap market and then compound it 20% and thank me in 3.5
And it'll add that
years.
to Steve's I told you so.
Maybe not 20%, but your point is right, which is, again, if you always look at Warren Buffett, if you look at him as a guide in the way he invests, right? Warren is sitting on 140 or 150 billion, right? Now, you could say...
Must be nice.
Well, you could say, yeah, but, he's already rich. But my point being is, yeah, but he wants to maximise the return on that capital, right? Now, Warren...
Arguably more than someone with 140 grand because way more risk.
Yeah, absolutely. But the thing Buffett understands is, dare I say it, wait for the fat pitch, i.e. wait for something to come along where you go, listen, I've got a reasonably good shot here at 10 or 11% compound, I'm going to take it, right? That's what you wait for. Because Warren's quite happy sitting there going, I'm getting 5.5 or 6 in bonds. that's fine until 10 or 11 comes along, right? Whereas, as you said, Jacob, 10 years ago, it was like I'm sitting here earning 1%. This is bullshit. I need to buy something to make money.
Well, there's so much conflicting advice out there because a lot of the stuff you hear and listen to goes, you want to get rid of cash as much as possible because it's just going to lose value with inflation.
Yep.
You don't want to hold a lot of cash.
Yeah.
You want to invest it.
Yeah.
Like that's consensus. So it's easy to understand.
Yeah, but it's also too, Tom, the stuff we talk about, industry incentives. Right? Fund managers make fees. Well, they're not going to make fees if you've got your bloody bank account stacked up with cash. Right? So they're going to convince you that there's some bloody ETF or some stock or some private equity or some alternative investment or gold or Bitcoin. Doesn't matter. They just want you to, activate your money so they can generate a fee. Now, they can dress it up in the bullshit of, it's all best for you, blah, blah, blah. Well, that's, that's garbage. As I've said before, the RBA did a study where basically you get 2%. Well, they don't want to talk about that, do they? No, because, we'd all go, what? You blokes are charging me all this money and, I'm getting a shitty 2%. So I think that's the, that's the hard part because you generally think that you've got to be active all the time. And it's really a matter of saying, sometimes there's no good investments and you've got to sit and wait for the market to turn. And then there's, as you know, when the market crashes, you can buy virtually anything and get 10 or 11%. That's when you want to go, now I'm going to activate my cash.
Yeah.
Right? But that's when a lot of people go, oh, my God, the world's so, uncertain. Oh, this is terrible. I'm going to keep my money in cash. And it's like, no, dude, now you can get 10 or 11. Now it's the time you deploy it. Oh, but like you said, Jacob, but what if it gets cheaper? Well, don't spend all your money, for goodness sake. But, at least kick it off.
I think it's difficult because the type of people who are interested in investing want to be active. They go, their headbutt. They want to be active.
Absolutely.
They want to move their money around and go, how do I make the most of it?
Yeah.
And you're telling those people that are more active in investing and generally in life to do nothing.
Well, not necessarily. That's why the three wells was developed, right? Because people like me say, I love this stuff. I live and breathe it. I love it, looking at it every day. So if that's the case, well 3, for example, if we think about superannuation, it's like you get someone like me who comes along and says, oh, Jacob, buy these 10 ETFs and just rebalance them once a year every 12 months. You go, is that it? Shit, mate, that's pretty boring. I've got all this cash sitting here, right? Well, shouldn't I be doing something? So, well 1 is for people like me and you who say, I really love this stuff. I want to do a bit every day or every week or, I just want to be active. Right? Well 3, you're active, but it's not exactly knocking the lights out if you, rebalance for, half a day every 12 months.
Particularly if you're starting off in your investing career as well, or you're younger.
Yeah.
But when we say active, it's not like you sat in front of a chart for 3 hours every day.
Absolutely. Yeah. It's probably, say, taking an active interest, but also, making a trade or whatever. But, yeah, it's not there watching the 5-minute candlestick.
Yeah, you get to clip the ticket every day.
Yeah, now go and live your life, right? Go and get on with it, right?
And well, too, while we're at it, it's a balance of both and in between slightly shorter time frame.
Yeah. So across the 3 wells, the idea is there's this thing called time. How do I have a strategy for different periods of time? Right? Because most of the mainstream, again, says, you just always focus on the long term. So my argument is, as you guys know, well, what if I'm sitting here on all this money and I got 6 months to live? Long term, why did you tell me I had to wait for the long term? No, I wanted to wait for the, I want to wait for the here and now. And it's a serious point because the argument with long term is, you just keep paying me fees for me to give you shitty returns, in the long term. And it's like, okay, but why? Why do I have to live my life once I'm 65 and I'm too old and I don't want to go and see Santorini, right? I want to see it when I'm 30, right? I want to do it now. So give me a strategy that generates money so every year I can say, hey, I made 10 grand, I'm going to go to Santorini. Mm-hmm. Yeah. Or, I'm going to Champs-Élysées or something. Not, I'm 67 now, I've got to cram in with all the others to do the trip to Europe, which I really want to do when I'm 30, because at 6 o'clock I'm tired and I want to go to bed.
Is that an insight into your life?
But
Half a glass of red and a nap.
There you go. Oh, footy's over, 9 o'clock. Oh, got to go to bed now. Got the podcast in the morning.
That's funny. All right, let's start to wrap it up, gents. There's a bonus section here. I think we've already covered it, just with the Japan set to join the AUKUS military technology.
AUKUS, mate, AUKUS.
Oh, I don't know.
Oh, God, you guys.
That's
You guys
why
got
you're
to start
here.
reading the papers.
Don't need to when you're here.
You've got to learn all this lingo. AUKUS, NATO.
But let's end on this, and then we'll wrap it up for next week.
You're going to touch on the chair?
On the chair, the
Oh,
chair of
chair.
the week.
Oh,
I
what's the
missed
chair?
that one. Stock buybacks
boring.
boost stock prices by reducing the number of shares in the company, but it can be misled as investors believe the economy is responsible or the individual company's performance when it in fact is really just an accounting trick.
Yeah, boring. Yawn. Less shares. The price goes up. It makes it look good. Really, it's bullshit.
There's
This
never
company
a
just
time.
buying their own shares.
And if you are
Yeah,
interested,
yeah.
go to the website. You can download the chart of the week and get added to the week that was mailing list for free.
Absolutely.
Bit of a treat.
Wallet free while it is. Well, get it inflation free, folks.
All right, thanks, gents. Good to see you both. We'll see you next week, hey?
Thank you.
See you guys.
Stay up to date on our socials. Just search for Total Money Management on Instagram and TikTok. For your free investor personality assessment, go to totalmoneymanagement.com.au. And as always, remember, we don't provide financial advice.